Welcome to Proper Wealth with me, Paul Mahoney, the show where we discuss all things wealth creation, including property. Today we're going to discuss collective investment schemes, an alternative to traditional buy-to-let. Joining me today is Rachel Stark from Cogress. Thanks for joining us, Rachel.
You're welcome. Thanks for having me.
No worries. So, Rachel, let's talk about collective investment schemes and I suppose how they can be an alternative to buy-to-let or at least part of a buy-to-let portfolio. If we start out by talking about the differences between traditional buy-to-let and collective investment schemes.
Well, I think the truth is that buy-to-let used to be one of the few avenues that investors could use to build a property portfolio. The alternative obviously was to be ultra high net worth and perhaps build an empire directly with a developer. And the truth is now there are far more options open to investors. And even those investors who are already in buy-to-let like those options because it allows them to diversify more freely with entry levels that would be lower than if they were going to go into a buy-to-let themselves.
Okay, so let's start with the entry levels. What are the usual entry levels so far as people, the amount of funds required for this type of investment?
Well, I mean, again, it varies enormously depending on what kind of investment opportunity you want to go into. So obviously you can invest in a property fund, which is a very traditional form of property investment, has been around for a long time, but you're not choosing the specific property development that you want to invest in. So if you want to have that freedom to choose, then there are things like crowdfunding and other collective equity investment schemes, as well as also collective debt schemes and opportunities that are available. And the entry level can be probably £10 all the way upwards, depending on the nature of that investment. Right,
okay, so I suppose that would appeal to some people who may not necessarily have the funds available for a buy-to-let, or maybe might want to spread their funds to achieve diversification.
Exactly, and I think the diversification is probably the key thing that people really like about it. They want to be able to pick and choose, and they want to diversify their risk and their portfolio, and this would very much allow them to do that.
All right, and for people who don't actually understand what a collective investment scheme is, what are they actually investing in?
Well, let's take, for example, a collective equity investment scheme. The most likely scenario is that you'd be investing in a specific project. If we talk about property, then there may be a specific property development, and you will be taking an equity stake in that development, but without having to fork out the whole sum of money that would be necessary if you were taking the whole 100% share. You can take a proportion of that.
So it's almost like joint venturing with the developers somewhat.
Exactly, it is very much like that.
Okay. That's interesting. So it gives someone the ability to get involved in a project they're interested in without necessarily taking on all the risk.
Exactly. Well, there is probably still less, I would say, without taking on all the risk, but without having to put out the full amount of money necessarily. Right. It's very important to still be aware of the risks that are...
having to raise million pounds to do it.
Yeah,
okay.
Precisely.
And I suppose joining with other investors and therefore spreading that risk somewhat.
Spreading the risk in that you can diversify your portfolio, I think, is the most accurate way to look at it.
And what would you say are some of the advantages and I suppose disadvantages of this as an alternative to buy-to-let?
Well, I think the advantages are, as I said, diversification and also probably the potential yield. Obviously, if you're taking an equity stake in something, if it's going to be, when you buy to let, you are normally investing in something for a long-term period of time, and you're looking for an income-generating asset. The typical yields tend to be around 4 to 5%. If you want something that is going to yield a higher return, then obviously you need to look at something where you're going to develop something, really improve it, and probably sell it off in a shorter period of time. And that's going to be the likely way you're going to earn higher returns. Obviously, you have to look at the risks that are associated with that as well.
Okay, all right. Of course, there's always a sort of risk-return type balance. So we've spoken about the size of investment. That can vary quite a lot. I assume that the time frames of the investments can vary quite a lot too? Very
much so, and I think with any investment of this type, it's very important that you do your own due diligence, so you're making an educated and informed decision. And I guess one thing to be bearing in mind is whatever platform or company you are investing in, being very aware of what due diligence they have done. Because again, in the sort of collective investment world, the degree of due diligence varies enormously. And so you really need to know your stuff before you make that decision to invest.
Yeah, okay, I certainly agree with that. Due diligence is always important. I suppose when it comes to something like a collective investment scheme, there's an extra level of due diligence, isn't there? Because it's not just the investment, it's who's offering you the investment
100%,
and the
exactly.
platform where your money
Yeah.
might sit, or where you're placing that money.
Yeah, exactly. So you might want to look at what is their track record, how much have they raised, what kinds of projects, what is the experience of the people in that platform, and also very much what is the information that they are providing you on the actual investment itself. The more information they provide, the more transparent that information is, then the easier it is going to be for you to make an informed decision.
Yeah, and I suppose the more peace of mind.
Yeah, 100%. I mean, certainly if I was to be presented with very opaque information about an investment, then it would make me very suspicious as to what I was getting into.
I certainly have seen, some of the guys out there offering almost unbelievable returns. But when you look into the information, potentially, it's not as transparent as you might want it.
No, and I mean, our view is that we should provide prospective investors with as much information as possible, including detailed financial information on the project they're going into, and be available to answer all the questions they may have in order to help them make informed decisions.
Yeah, and I suppose that's probably required, given this is a somewhat new market, isn't it? It's a new way of investing, and having exposure to property in some cases can offer better returns. Balancing that with risk and understanding what those risks might be is probably pretty important for people to have peace of mind around.
Yeah, very much so, particularly since the platforms out there are not the big traditional banks that you may have seen around on the high street for years and years, and so you want to make sure that you feel that you trust them and you know enough about them before investing.
Okay, so with regards to investing in collective investment schemes, are they limited to any particular type of person or investor?
Again, it very much depends on what you're investing in. I mean, I think in some cases peer-to-peer lending is considered a type of crowdfunding, and again, that is, I think, open to all people. My understanding is that most equity crowdfunding or collective investment is normally limited to people that qualify as high net worth individuals or sophisticated investors.
Okay, and what is a high net worth individual?
So a high net worth individual is somebody that is earning £100,000 or more in income or has net assets of about £250,000 or more, excluding their personal home.
Okay, great. And what's a sophisticated investor?
A sophisticated investor, there are many potential brackets that you could fall into. For example, if you're an angel investor, you'd be a sophisticated. If you'd invested in unlisted assets, investments, you'd be sophisticated. If you're a director of a company, I think you constitute a sophisticated. Yeah, okay. Those sort of.
All right, well, that's a good point, because I suppose some people wouldn't quite know whether they fit into that bracket or not.
And very much the platform that you invest by should make sure that those categories are clear to you before you qualify, to make sure you know what it is that you're doing.
Yeah, of course. Okay. All right. So I suppose understanding what is open to you so far as the different collective investment schemes out there, and therefore I suppose whether it's suitable for each person as an individual.
Yes.
Are there different levels of regulation in collective investment schemes?
So yes, there will certainly be some that are regulated and some that aren't. And I guess if you are investing, I would recommend that you would look very carefully at whether that platform is FCA regulated, because that may give you some greater peace of mind to know that they're going to adhere by certain rules of fairness to customers and transparency in their communication.
Yeah, okay. So I suppose by being regulated, there would be more requirements for transparency.
Very much so.
And potentially a little bit of recourse over, misdeeds or, anything that's untoward.
Yes, although just because a company is FCA regulated doesn't mean that the investment itself is necessarily regulated, and it may not be covered by the Financial Services Compensation Scheme. Okay. So again, that's something that as an investor you should do your due diligence on.
So it seems as there is quite a lot to consider, and a lot of varying types of investments, varying due diligence, all those sorts of things. Potentially something worth seeking advice on.
Potentially,
as far as understanding these things.
Yes, it very much depends on how much money, obviously, you're looking to risk or to invest, and what your background is. Yeah. But if it's something that you feel uncertain about, whether it's asking your friends who might have done something similar or asking for professional advice, that's always a beneficial thing to do.
Yeah. Okay. It seems to me like there are certainly some standouts with regards to collective investment schemes and peer-to-peer lending and all those sorts of things. Some companies are doing it quite well, and others potentially not doing it as well. There's been some concerns raised, I think, about the ones that aren't doing it so well. So maybe worth avoiding those ones.
Yeah, very much.
With regards to fees, I assume they vary.
Yes.
How do they vary? What determines that?
So, I mean, that will be based on the platform itself, obviously, and it's something that, number one, you should make sure those fees are very clear to you from the outset, because again, a warning sign would be if you can't find that information about the fees, or it's a little bit opaque. Some fees may be upfront fees, there may be fees that are based on the success of a certain investment. Again, it depends on the nature of the investment.
Yeah. And generally, are the returns quoted as net of fees?
Again, that will differ, and that's a very important point, because obviously it's much clearer to you as an investor if those projected final returns are quoted net of all fees, because then you really know what it is that you're potentially going to get. It's more opaque when they're hidden.
Yeah, well, I suppose that's probably what's turned a lot of people off things like funds and also pension schemes and things like that, where they're being quoted a reasonable return, but then they've got a big chunk of fees coming out of that return. So understanding what that chunk of fees might be, I suppose, is really important to understand what your return is going to be at the end of the day. And again, I suppose that the transparency of that would differ across the board. So making sure that is as transparent as possible. Great, some excellent points there, Rachel. Thanks for joining us. Join us after the break for more discussions on collective investment schemes as an alternative to buy-to-let property. Welcome back to Proper Wealth with me, Paul Mahoney. Today we're discussing collective investment schemes as an alternative to traditional buy-to-let property. Joining me again is Rachel from Cogress. Thanks for sticking with us, Rachel. We've spoken quite a lot about collective investment schemes, how they work, different things to consider. Perhaps we should talk now about some of the changes with regards to buy-to-let, the tax changes, potentially Brexit, how that might affect things, and I suppose how that relates to the collective investment schemes.
I think there have been various fundamental changes that have affected the property market as a whole that investors should be aware of. That is changes to the tax regime for buy-to-let investors, it's stamp duty changes, and Brexit. And those have very much changed the investment landscape. And I guess if you're considering investing, and it's worth understanding the impact that it will have. Certainly, the part of the market that has been most affected, particularly by stamp duty and Brexit, is the really premium end of the market. So developers were piling into high-end, premium central London properties, but with really, really high capital values. But that part of the market has really started to dry up in terms of the transaction volumes. So if you've got a property there and you're hoping to sell it, it has become much more difficult to do so.
Yeah, it's interesting how those changes have affected the overall demand and, as you say, the transactions, and how that flows through to developers and then to things like collective investment schemes. Certainly, I've noticed less and less people going for high value, low yield properties, predominantly, as you say, prime central London, and putting a bit more focus on lower value, higher yielding properties. And I suppose that has been caused by the tax changes, which are accentuating the importance of yield. And potentially things like Brexit, uncertainty. People aren't wanting to spend, multiple millions of pounds on a single purchase anymore. They want to take a little bit less risk, I suppose.
So yes, I think that one of the important things to do is to look at how your investment strategy may need to adapt to the changes that have taken place. And certainly many of the collective investment schemes, if they are investing in property, will be doing just that. And certainly our research shows, supported by other expert research, that you should be looking further afield, zones 2 and beyond if we're talking in London, areas with good transport links still, but where they are perhaps multi-unit properties, mixed use, residential and commercial, where the individual capital value is £1 million or less, the price per square foot is £1,000 or less. That is where it's believed that there is a more sustainable demand. People are still looking for that first and second home and still willing to move. Yeah,
there certainly is quite a shift, as you say, away from the high valley toward the more cost-effective or investment-effective type properties. And it's interesting how that has flowed through from demand to developers, then either to the collective investment schemes and to the end user. Or even through to funders and what funders are looking to get involved in. And that's happened quite quickly, hasn't it? over the last sort of 12 to 18 months even.
Yeah, well, I
with all
mean,
these
very
changes.
much since Brexit and stamp duty changes
Yeah.
took place, they were, sadly, none of us predicted them, but they have had a very fundamental and dramatic impact on the market.
Yeah, okay. And I suppose from the end user's perspective, you know, our viewers'
Yeah,
perspective, it's probably quite important to understand those things. You know, if they are looking to invest in collective investment schemes, making sure they're investing where it makes sense, where that end demand lies, because if they're investing in a development and that development doesn't sell at the end, I suppose their capital is even more at risk, isn't it?
Yeah.
If that development doesn't end up being successful.
Very much so, and that's where I guess due diligence, which we keep harping on about,
Yeah.
becomes even more important.
Yeah.
Where there are going to be probably fewer successful schemes out there, and it's certainly much harder to find them.
Yeah.
So what you want to be doing is making sure you do very thorough due diligence on the developer
Yeah.
and the development itself. Now, hopefully, whatever platform you're investing in will do that due diligence for you,
Yeah.
provide you with all that information so you feel informed. You want to look at the developer's track record. What is their experience of building in that particular area? Do they have planning permission for the site? What is that area like, as we talked about before? Do you understand who the end buyer is going to be and how sustainable that demand is going to be?
Yeah.
I mean, to be honest, the amount of due diligence you could do is almost endless. Those are some of the few things that is certainly important to look
I
at.
suppose it all kind of boils down to, though, if there's going to be end user demand, doesn't it? Mm-hmm. You know, there's lots of things that determine that end user demand, but at the end of the day, it's about determining if that end user sort of target market is going to buy these properties and buy them pretty quickly.
Yeah, certainly. I mean, if you're investing in a development for a short-term exit, then there are various risks that one should be aware of. There's obviously the developer risk, there's construction risk, potentially planning risk, but saleability at the end is probably one of the biggest things to be aware of in the current climate.
Yeah, and something that I've seen, certainly a common misconception when it comes to whether it's investing directly in property or with a collective investment scheme, is only investing in things that you personally like. And I suppose that doesn't really matter at the end of the day, does it?
No.
What you personally like.
It doesn't, but it is a very common thing that investors that's a route that they go down.
Yeah.
And to some extent, I understand it because particularly, for example, if you know an area, then you may feel more comfortable investing in that area
Yeah.
because you just feel more informed about it. But ultimately, you're not the person who's going to be living in that property at the end of the day.
Yeah.
So the most important thing is to think about who is and how likely it is that they will buy.
Yeah, and look, I bang on about it, but making sure you're very commercially minded and unemotional when it comes to investing, understanding what the target market wants and where that demand is going to be, as opposed to, you know, what you might like, or
Very
the
much
colours
so.
or the carpet,
Yeah,
or, you know,
yeah.
all that sort of stuff. Okay, excellent. With regards to different ways of investing in collective investment schemes, so we've kind of been talking about just investing in general, and I suppose people would look at that as, you know, cash in the bank, that you're investing into one of these platforms or schemes. Are there other ways of investing in collective investment schemes?
Yes, so I mean, firstly, I would point out that as well as investing in an individual capacity, there may be some schemes where you can invest in a corporate capacity, which may appeal to you depending on your
So
situation.
from a limited company into that platform?
Exactly,
Okay.
yes. Or some sort of partnership structure into that platform.
Right.
The other thing to perhaps consider is whether you can invest via your pension, which may be in the form of a SIP or a SAS, which is a small occupational pension scheme.
Yeah.
I am not a pensions or a tax advisor, so I would caveat what I say, but ultimately my understanding is that as a SIP pension, you cannot invest in residential property, but you can invest in commercial property, so that may be something to consider.
Yeah.
SAS pensions are more flexible, slightly more flexible, and there may be possibilities to invest in a more flexible manner, but you should obviously always seek advice when you're considering.
With regards to
doing
the
it.
idea of residential and commercial property from a SIP, that's something I understand. Does that apply, though, when investing through a collective investment scheme?
Yes, very much
does,
so. Now,
okay.
not all collective investment schemes may necessarily enable investment via a SIP or a SAS, but regardless of the form in which you're investing, you can't invest in residential property using a SIP.
So if a collective investment scheme is invested in commercial property, or is funding a commercial property development, that would allow SIP investment, but not if it was investing or funding a residential property.
Yes, and again, it would have to be 100% commercial rather than any kind of mixed use.
Right, that is very interesting. Certainly what I've seen is that people don't necessarily realise they can utilise their pensions, and they kind of just think about it as this thing they've put money into for a long time and they don't really keep an eye on it, or don't really know what's happening with it. So that's an interesting way of them perhaps raising funds they didn't know they had or didn't know they had access to.
Yeah.
And often is an option for them to invest that in traditional buy-to-let. So it ties in quite well to our discussion.
Yeah.
Okay, right. So with regards to the SaaS option, that does allow them to invest in both residential and commercial?
Yes, it can do. The rules for SaaS are more flexible than they are for SIP pensions.
Okay.
But again, it's very much something that you should seek professional advice.
Yeah, that's a running theme throughout this show, is that when making major changes, life-changing changes to your finances, it's always worth seeking advice. But it's good for people to see in a general sense.
Yeah.
What their options are.
Mm-hmm.
That's certainly something that we've covered a lot. So we've spoken quite a lot about the different options with regards to collective investment schemes, how that can work as part of a portfolio, both buy-to-lets and shares, the overall sort of investment strategy. Why do you think collective investment schemes have become more popular and are becoming more and more popular within the market?
I think they're part of an overall trend of new entrants in the financial services space, which has been spurred on, I guess, by regulatory changes, by dissatisfaction with banks, and very much by technology enabling some of these players to come around. And I think once they're there, they offer an amazing opportunity to investors to invest in a whole wide range of opportunities that wouldn't have been available to them before.
Okay, that's very interesting. What do you feel as though is the future of these collective investment schemes or crowdfunding type platforms?
I think they will continue to grow. If you look at things like peer-to-peer lending, that has grown enormously over the last few years. It's got a really big chunk of the market. Crowdfunding is still relatively small in comparison, and there are traditional players looking to get into peer-to-peer lending, and I expect that crowdfunding will continue to build in the way that peer-to-peer lending has, and we will have potentially more players, but certainly the players that exist getting bigger and more established. Perhaps there will still also remain very specialist players who are offering very specific types of investment. But I certainly think it's a type of investment opportunity or platform that is here to stay and will continue to make inroads into traditional players.
It will be interesting to see where it all goes. And obviously different investment options for people is never really a bad thing, so long as we say, they are doing their due diligence and they're making the right investments for their particular situation and their goals. Certainly as part of the overall sort of strategy that they might have. Okay, excellent. Thank you, Rachel. Some great points there. I'm sure our viewers learned a lot. Thank you very much for joining us here on Proper Wealth with me, Paul Mahoney. Join us next time for more discussions on wealth creation, including property.